Hello and welcome to this video on monetary union. So in the video, we're going to look at what monetary union is, the benefits and costs, and then we're going to spend the second half looking at the story of monetary union in the Eurozone. So let's start off with what do we mean by monetary union. Monetary union, quite simply, is a situation when at least two countries share the same currency. The most famous example of this is probably the Eurozone. In Europe, we have many countries that share the same currency, the euro. It's important here that we don't confuse this with the EU. The EU is a common market, a trading bloc. The Eurozone is a monetary union. There are more countries in the EU than just use the euro. So, what was the history of the Eurozone? Well, the European Union is how it all originally was stemmed, and this was envisaged after World War II in order to try and bring more peaceful cooperation across Europe. In the 1950s, there was a free trade area created, and then on the 1st of January 2002, a single currency was launched for a number of countries called the euro, and it replaced their original currency. So, for example, Germany replaced the Deutschmark with the euro, France replaced the franc with the euro, and so on. Now, if you have one country, one currency, you have one central bank. And in Europe, for the euro, it's the European Central Bank that have control of monetary and exchange rate policy. So what are the responsibilities of the European Central Bank? Well, they're responsible for distributing the notes and coins throughout the Eurozone. Crucially, as a central bank, they set interest rates. And they do this to try and target inflation close to below 2% across all the Eurozone countries. They're also responsible for maintaining a stable financial system, managing foreign currency reserves, and they are overall responsible for monetary policy. But fiscal policy, so government spending and tax, those decisions are left to the individual countries, but there are some limitations. So in order to join the euro, the idea was that countries had to meet certain criteria. So if we're going to have one central bank and one monetary policy, we need to try and ensure that our economies are similar. So they're going to have similar levels of inflation. They're going to respond in the same way. So there were a number of criteria that that countries needed to meet in order to join the euro. The first one was that the government's budget deficit, so government spending, or government tax revenue, should I say, minus government spending, must be below 3% of GDP. The public debt, or the national debt in total, must be below 60% of GDP. The rate of inflation in the country must be within 1.5% of the average of the best three performing member states at that time. And long-term interest rates in the country must be within 2% of the average interest rate in the three economies with the lowest inflation. The exchange rate had to be within bounds set by the exchange rate mechanism. So prior to adopting the euro, that country's exchange rate would need to be fairly similar or fairly stable, in terms of its rate against the euro. If these criteria are all met, then the country would be eligible to join the euro. Although some critics have argued that many countries have joined the euro even though they haven't met the convergence criteria because of a political will for them to join. So what are the advantages of being part of this club, being part of the euro? Well, there'll be reduced transaction costs. They don't have to pay to exchange money in order to do trade. So it will reduce the exchange rate risk for trade and the transaction costs. We should see a big increase of trade. This might also encourage foreign direct investment. We might see less speculative attacks on a currency because they are a kind of a more powerful currency base now. Also, if we have one central bank but they're particularly well skilled, then we might benefit from their better macroeconomic management than from our own government. Okay, but what about the disadvantages? Well, the key one, and we'll come to see this a little bit later, is the loss of monetary policy independence. What if we have an inflation rate of 5% in Greece and 1% in Germany? What do we do to interest rates? How did the central bank both cut interest rates and raise interest rates at the same time? It's very difficult to do that, or impossible to do that. We have restricted use of fiscal policy through the Maastricht criteria. We have some element of loss of political sovereignty. So we have some countries that have little say in the setting of their own monetary policy. This may ultimately result in unemployment, and differences in inflation may limit economic growth. So we're now going to look at the experience of monetary union in the Eurozone. We're going to focus on the experience of Germany, Greece, and Spain predominantly. So our first chart here shows the economic growth rate, the GDP growth rate of countries from the introduction of the euro in 2002. And we can see, generally speaking, up until 2008, all these countries here, so the red being Greece, the yellow being Spain, and the blue being Germany, experienced high levels of economic growth. In fact, Greece and Spain in particular experienced some of the largest or the highest rates of economic growth over this period. What we see, though, around 2008 is a big crash in the rates, in particular for Greece and Spain, whilst Germany managed to maintain some economic growth. So why was this the case? Why did Germany seem to eventually do well, whilst Greece and Spain struggled despite the initial optimistic appearance? This chart illustrates that even further. We can see here over the economic output over the period 2008 to 2014. So we can see that German economy is growing very healthily, whilst Greece and Spain not doing quite so well here. We have a contraction in economic growth. So again, the question, why was this the case? And we need to start our story really by looking at inflation rates. So a quick reminder here that the inflation target in the Eurozone is 2%. So countries should be close to, but just below 2%. And so when we look at Germany in blue here, we see that for most of the time, actually, yes, they are close to, but below 2%. Inflation is pretty much on target. But what we notice for Greece and Spain is that inflation is persistently higher than target. So what would that suggest? Well, it would suggest that Greece and Spain could have done with higher rates of interest from about 2003 onwards to bring inflation down in line with the target. But the impact of that would have been to push Germany down towards 0% inflation and possibly even deflation. So when we look at the setting of interest rates over time, we see that even when Greece and Spain wanted a rise in interest rates in 2003, we see that they are being cut by the European Central Bank so that Germany can meet its target. So what we seem to see is quite low interest rates throughout the period here, and that overall, if we were to say who is the interest rate suiting, is it suiting Germany or is it suiting Spain and Greece, we would say that the interest rate here is really suiting Germany's economy the most, and it's not suiting Greece and Spain. They're experiencing much higher levels of inflation. So we have this problem here. The fundamental problem, we cannot set monetary policy for Spain, Greece, and Germany so it's effective for all three countries. These economies are just too different. Greece and Spain require higher interest rates to control inflation compared to Germany. So what does the impact do? What is the impact from 2003 onwards of persistently higher inflation? Well, we see in many countries like Spain, Italy, France, we see an increasing rise in labour costs in relation to Germany. So these countries, Spain, Italy, France, Greece, we can assume in there, are becoming more expensive countries in which to produce products. So where are we going to buy our products from? We're not going to buy them from Spain and Greece, we're going to buy them from Germany. This may be combined with other productivity issues, has a severe impact on the trade balance for these countries. We see that when we look at trade, Germany is exporting way more than it's importing, whilst countries like Spain and Greece are going on an import binge, fueled in part by borrowing through those low interest rates that we talked about earlier. So we have lots being produced in Germany, not much being produced elsewhere in Europe, and not much being but being consumed through taking on debts. So if there's lots of work being done in Germany and not much work being done elsewhere, we start to see the big increases in unemployment. Here we have Spain in yellow and we have Greece in red, and we can start to see unemployment rates climbing to nearly 30% in these countries. Whilst in Germany it's quite a different story. We see actually unemployment still falling throughout this period. So this is in part due to the trade balance that has emerged. Stuff is being produced in Germany, low unemployment, whereas less stuff being produced in Spain and Greece, and then as a result higher unemployment. So if higher unemployment, what does that mean for the economy? Less tax being paid, more government spending. What does this do for governments? Well, they have to borrow a lot more money. We see here that the national debt as a percentage of GDP in Greece is soaring to a whopping nearly 175% of GDP. Likewise, when we look at the experience of Spain, we see significant increases in national debt as a percentage of GDP. And this brings us to the current debt crisis. Governments struggling to repay their loans, having to have bailouts from the other governments within the Eurozone. So in this video, we've looked at monetary union, we've looked at the benefits and the costs, and then we've looked in particular at the story of the monetary union within the Eurozone. It started out quite well, but those fundamental differences between the economies and the lack of the ability to set their own monetary policy eventually causes some issues and the government debt crisis that we're aware of today. That's it. Thanks very much for listening.